Good morning, everyone, and thank you for choosing Market Briefing analysis of today's financial news. Every day, our goal is to provide you with a thorough and knowledgeable analysis of the most relevant financial news to help you navigate the complex economic landscape. Let's begin our daily review. Financial News, June 23, 2023. Investors across the globe found solace in the safety of bonds today as concerns over higher interest rates and weak economic data from the Eurozone intensified fears of an impending recession. This flight to safety has led to significant fluctuations in the stock markets, with many indices experiencing their largest weekly declines in over 3 months. European shares, in particular, were heavily impacted by these developments. Siemens Energy AG, a prominent energy company, saw its shares plummet by a staggering 36% following a profit warning, causing a drag on the broader market. Uncertainty looms over the future trajectory of stocks, leading to a decline in U.S. index futures as well. Paul Donovan, chief economist at UBS Global Wealth Management, remarked on the shift in market sentiment, stating, "Financial markets have had one of those switches in the narrative that happen occasionally, and are starting to worry about higher interest rates driving recessions." Turning our attention to the bond market, a rally in European bonds sent German yields tumbling. 5-year German yields experienced a significant drop of up to 15 basis points, the largest decline since April. This movement also influenced U.S. Treasuries, with the 10-year benchmark note shedding 7 basis points. Economic data from Germany and France further exacerbated concerns about the global economic outlook. German business surveys conducted by S&P Global revealed a more substantial loss of economic momentum than anticipated in June, driven by a slowdown in services and sustained weakness in the manufacturing sector. France, too, showed signs of a potential slump in its economy during the second quarter. These figures prompted a sharp decline in the value of the euro. Weekly flow data highlighted investor apprehension about the economic landscape, as funds were pulled out of global equity markets and channeled into bonds. Approximately $5 billion was withdrawn from global equity funds, while $5.4 billion was added to bond investments. Looking ahead, Bank of America strategists, referencing EPFR global data, suggest that U.S. stocks may face more downside than upside over the next 2 months. They cite concerns surrounding banks and property firms, which still bear the remnants of the previous recession. In recent statements, Federal Reserve Chair Jerome Powell indicated that the United States may require 1 or 2 more interest rate hikes in 2023. This announcement has impacted Treasury 2-year yields, which remain around 4.8%, near the highest level since March. Shifting gears to central banks, the Bank of England made an unexpected move by raising its benchmark interest rate by 0.5 percentage point. This decision was driven by concerns of rising inflation fueled by a surge in UK retail sales during May. Meanwhile, Norway's central bank also intensified its response to stubborn inflation and a weak currency by accelerating its tightening measures. Amidst the prevailing uncertainties, it is crucial for investors not to lose sight of the secular bull case for equities. Sarah Ponsick, a financial advisor at UBS Private Wealth Management, reminds us to consider the long-term growth potential of stocks, even if the immediate upside may be limited. The European Union is seeking to reduce its economic dependence on China by diversifying its supply chains, decreasing reliance on the Chinese market, and attracting foreign investment from other regions. However, the bloc is cautious about potential retaliation from Beijing, as exemplified by China's recent block on exports from Lithuania, according to an anonymous senior EU diplomat. Turkey's central bank, under the leadership of Governor Hafizgay Erkan, took action to tackle the country's soaring inflation by doubling the interest rate from 8.5% to 15%. However, some analysts criticized the hike as being too modest, as expectations were for rates to reach 20%. Turkey's inflation rate reached a staggering 39.6% in May, exacerbated by President Recep Tayyip Erdogan's preference for keeping rates low. Before we continue with our analysis, we'd like to remind you of your support for our channel Market Briefing analysis of today's financial news. If you're enjoying this video and find our content useful and engaging, please consider giving it a thumbs up and subscribing to our channel. This helps us grow and bring you even more quality content. Now, let's get back to the financial market news and the latest updates. Federal Reserve Chairman Jerome Powell, in his Senate testimony, indicated that new regulations will likely not apply to banks with assets below $100 billion. These regulations would have increased capital requirements for banks among other conditions. Separately, FDIC Chair Martin Gruenberg stated that these rules are expected to take effect next year. Turning our attention to the markets, U.S. stocks mostly rebounded on Thursday, with the S&P 500 and Nasdaq Composite ending their three-day losing streak. However, the Dow Jones Industrial Average remained relatively unchanged. In Europe, the Pan-European Stoxx 600 experienced a 0.51% decline, but British online grocer Ocado stood out with a remarkable surge of 32.05% amid speculation of a potential acquisition by Amazon. Despite the recent rally in the S&P 500, market strategists from UBS and JP Morgan Chase are cautioning that the stock market may be overvalued. While the index is attempting to surpass its previous high from October 2021, signaling an official bull market, these experts believe that caution is warranted. As investors have grown accustomed to the idea of declining inflation and gradual interest rate decreases, they are now confronted with the reality of potential continued rate hikes. Fed Governor Michelle Bowman emphasized the need for additional policy rate increases to further reduce inflation. This sentiment echoes Chairman Powell's previous remarks and challenges the notion of a pause in rate hikes. Interestingly, technology stocks, including Amazon, Apple, and Microsoft, saw gains amid expectations of more rate hikes. Investors seem to view artificial intelligence as a protective barrier around earnings, capable of withstanding the impact of high interest rates. However, the overall market may face challenges, as the Nasdaq is on track to break its 8-week winning streak, and the S&P's modest gains may not be sufficient to sustain its 5 consecutive weeks of positive performance. The global economy is influenced by a bearish market sentiment, central bank actions, and concerns over overvalued stocks. The path ahead remains uncertain as investors navigate the potential impact of interest rate hikes and inflationary pressures. Key events this week. Fed Bank of St. Louis President James Bullard speaks, Friday. Some of the main moves in markets. Stocks. S&P 500 futures fell 0.4% as of 4:46 a.m. New York time. Nasdaq 100 futures fell 0.6%. Futures on the Dow Jones Industrial Average fell 0.2%. The Stoxx Europe 600 was little changed. The MSCI World Index fell 0.4%. The MSCI Asia Pacific Index fell 1.4%. The MSCI Emerging Markets Index fell 0.9%. Currencies. The Bloomberg Dollar Spot Index rose 0.5%. The Euro fell 0.9% to $1.0861. The British Pound fell 0.3% to $1.2709. The Japanese yen was little changed at 143.05 per dollar. The offshore yuan fell 0.3% to 7.2151 per dollar. Cryptocurrencies. Bitcoin fell 0.4% to $30,037.39. Ether was little changed at $1,888.44. Bonds. The yield on 10-year treasuries declined 6 basis points to 3.74%. Germany's 10-year yield declined 14 basis points to 2.36%. Britain's 10-year yield declined 13 basis points to 4.24%. Commodities. West Texas Intermediate crude fell 1.7% to $68.35 a barrel. Gold futures rose 0.3% to $1,929.90 an ounce. In conclusion, we'd like to thank you for watching Market Briefing analysis of today's financial news. If you enjoyed our insights and found the information helpful, please consider leaving a like and subscribing to our channel to stay updated with future analyses. Thank you again for your support, and we'll see you soon with more fascinating news. Remember, the information in this video is purely informational and does not constitute investment advice. Always consult with a professional before making financial decisions.